Hello, everyone. Welcome back to another episode. I'm your host, the Millennial Investor, and today we have a fun episode to go over. We go over my monthly update on my channel, showing a monthly updates with my activity feed, including my referrals, my deposits, my trades, my buys, my sells, my dividends, all that stuff you can need to know. And more importantly, we're about to update these 4 charts. So if you're ready for that, go ahead and take a mental picture of these 2 charts right here, and then we're going to update them in 3, 2, 1. And there you go. There is the update on these 2 charts. We had an increase in annual dividend income just like we have every single month since starting the channel. We went from 66 to 75 to 82 to 94 to 107 to 130 to 196 to 247. And then now we increased this month a little bit to 269. So we are now up to $269 in passive income. And what's so great about this money is that this money takes absolutely no work for me to do. And all I have to do is go to bed at night and receive this dividend income while I sleep. So let's go ahead and take $269 and divide it in our calculators. 269 divided by 12, that works out to about $22.42 a month. Every single month, I'm going to get about $22 just to fall asleep. And if you take 269, divide that by 365, every night that I fall asleep on my pillow, I'm going to get about 3/4. I'm going to get about 75 cents. But my monthly dividend income, it was kind of a slower month. November usually is. December will be much better, should be closer to around $30. But December will be a lot bigger, but $13 is still an improvement on a quarter-over-quarter basis, where last quarter we got $4 versus this quarter $13. So much better than what we were expecting. And now it's time to go ahead and update you guys on these next 2. Let's go ahead and get updated on the portfolio value and the monthly YouTube income. So go ahead and take a mental picture, and here we go. Get ready for an update in 3, 2, 1. And there you go. There's the update on the portfolio value and the monthly YouTube income. As usual, every single month we've had an increase in portfolio value through the referrals, through the dividends, through the increase in share prices and all that good stuff, from $1,500 to $1,873 to $2,352 to $2,643, $3,033, $3,738, $5,475, $6,840, and now we are up to $8,119.02. What an incredible growth story we've been doing with this safe, conservative dividend income. Not a bunch of high growth tech stocks like your Shopify's and your Teslas out there. We're just doing boring dividend investing, guys. We're owning Coca-Cola and Starbucks and Home Depot and Johnson & Johnson. We're having some great growth from my deposits, fueling my dividend growth, and we're getting some great performance out of this portfolio. And then going last but not least, let's go ahead and look at my monthly YouTube income. It did take a steep drop off. Last month was not very good. We didn't have a lot of mentoring calls, and we only had so many referrals, but still, $161 is much more than I could ever ask for, considering that this is just a YouTube channel showing my basic investments. But overall, guys, this is going to be a fun video. We're going to go over the 26 companies that I currently own based off this little chart preview that you see right here. This is what you will see on my screen when you look at the referral to open up an account and invest in my pie yourself. Out of these 25 companies that I currently own, they do pay me that $269, but more importantly, if you want to use the brokerage that I currently use, the brokerage that I currently use is M1 Finance, and if you sign up and deposit $100 to the platform, you'll get $10 just for signing up. You'll also support the channel, and so far we've had 58 people do that. So if you want to be number 59, if you want to be number 60, go ahead and sign up, and all that's in the description as well as lots of other things, including the link to sign up with my pie. This is if you want to invest in the 25 companies that I own. There's also other things as well, like mentoring calls if you want to sign up for that. Yada savings accounts if you want to help save money, or if you want to get signed up with a credit card and get some sign up bonuses, that's all down there as well. But let's go ahead and get started. In my portfolio over the past month, we saw about $511.62 worth of gain, 6.8% on a money weighted return, 487 coming from market gain, 23 and some change coming from earned dividends. And overall in the portfolio since day one, going back to April 3rd when we first started this portfolio, we are up $1,241.89 in gain, exactly a 37% money weighted return, $11.49, almost $11.50 coming from market gain, and $91.92 coming from earned dividends. And let's go ahead and get into my number one investment, what is tied for my number one investment. Now, before I go ahead and jump into that, if you guys might notice, if you follow along with me, there's a slight change, and I'll go ahead and address that in the next video. I made a change in this portfolio literally today. I sold out of one company, I also changed some weights around, but tied for my number one investment, we have Broadcom. Broadcom is a company that is, in my opinion, the best dividend growth company out there if you want to invest in the tech sector. This company has well over a 3% dividend yield, due for another dividend raise at the end of this year, and this company has massive growth. Something fun that I wanted to show here real quick. Let's go ahead and go to my activity feed. And in my activity feed here, we're going to scroll to my very first transaction. Let's scroll through here. Let's go to the bottom and let's find Broadcom. Now remember, I was so bullish on this company. I was buying it like crazy when it was $237 a share. $237. And today, that exact same stock, that exact same company is no longer worth $237 a share. It's worth $400. And just the other day, it was actually over 400. It was like 405. This company's had some stellar growth, some great dividend purchases that I've had along the way as I continually compound my shares. The management team is excellent. The business model is excellent. I love this company. Do some research into it. And I also have some videos going over the company individually as well. So between their thousands of dollars in patents, their billions of dollars of research and development, they're set up very well for the long term. And speaking of companies set up very well for the long term, we have Realty Income, my #1 real estate investment trust. This is a very popular stock out there among dividend investors. And one of the great things about Realty Income is that it is unique in my portfolio. It is the only company in here that not only pays dividends every 30 days, but raises its dividend a minimum. The key word there is minimum. But raises its dividend a minimum of 4 times a year. On 2020 here at the end, I believe it's on track to raise it 5 times. But this company has great share price growth, great dividend yield, incredible dividend yield, great dividend growth. When we talk about this company, if you're bullish on real estate in the United States in general, then you gotta own some Realty Income. It is the best company for a real estate investment trust. If you're a dividend investor, easy money stock there to own. And speaking of real estate investment trust, one of my largest investments, which is my second largest real estate investment trust investment, WP Carey, has an incredible dividend yield. Now, before I go into this company, I want to mention something. Usually, a lot of times with the S&P 500 average return, you're usually going to look at something like a 6, 7, 8, 9, 10% average long-term return over the course of 10, 20, 30 years, right? Probably closer to something like that of 8, 10, 12%. But when you look at this stock, regardless of where the share price goes, let's say that 10 years from now, it was still $70 a share. Very unrealistic, probably not going to happen, but let's say 10 years from now, it's still $70. Well, no matter what happens, as long as they maintain that dividend payment, you're getting a 6% return just off of the dividend. 6% return just off of the dividend. That yield's actually a little bit off. M1 Finance goes off a trailing 12 month. Actually, if you base it off today, it's actually a little over 6%. But this company is one of the best real estate companies in the stock market. It is very defensive, very recession proof, and this company can last through pretty much all economic weathers as they continue to raise their dividends even throughout the pandemic. Raised it already 3 times in 2020, on track to raise it a 4th, and I love this company. It's one of my largest investments, and this company right here is my biggest dividend payer, currently paying me out just WP Carey alone $28 a year just to own it. And next we have Southern Company. Southern Company is a stock that I think is a very safe, stable company if you're a dividend investor that is wanting some defensiveness in their portfolio. Southern Company is a utility company that basically just provides electricity and natural gas to its customers. So the way I always look at it, right now you probably have a decent income, you have a decent job, but let's say right now that you were to lose your job. Right now, overnight, you were to get fired. Okay? It's probably unlikely that you're going to go buy a new flat screen TV. It's probably unlikely that you're going to go out and buy a new truck, a new vehicle, whatever. Any kind of big purchases like that, you're probably not going to be making because flat out, you ain't got the money. But guess what? Would you probably still pay your light bill if you could? Absolutely. Would you still put food on the table? Absolutely. That is one of the basic necessities that everybody needs. Food, lights, water, shelter. And notice how it said lights in there? Well, guess who powers the lights? You're looking at them, the Southern Company. So when you're buying into this company, you're already locking into a guaranteed 4% plus yield that does get raised every single year as we track along this chart right here. It has a steady little increase over time as the company continues to grow and they increase prices. But the Southern Company, a very safe old person, retiree type stock. But that stock is very defensive in pretty much any economy out there. Next up, we have the highest grower and the lowest dividend payer in the portfolio. This company has less than a 1% yield, about a 0.58 to be exact. And you might be looking at this company, Visa, the one that is one of my favorites. You might be thinking to yourself, wow, it went from $80 a share to 200 plus in the matter of 5 years. I think I've missed my mark. I think I've already missed my opportunity. The train has left the station. I don't have any opportunity to invest in this company. Well, guess what? I want to go ahead and say it publicly right now. This company has grown massively to $350 billion to $208 a share, and this company's just getting started. I want to go ahead and put my reputation on the line and say 10 years from now, 15 years from now, this company will be a $1,000 stock. You heard me correctly. In the next decade, by the end of 2030, end of 25, sometime in the next 10, 15 years, this right here, this company is going to be a $1,000 stock plus. This company is still growing at massive, massive levels. Usually in normal economic sessions, it is growing at 10% plus every year despite its massive size. And basically the way I look at it, do you think that online transactions are going away anytime soon? Do you think that mobile payments are going away anytime soon? Credit cards, debit cards, all that type of stuff that Visa gets money from. And guess what? I love their business model. They have an incredible business model with some of the best margins compared to any company out there. This company continues to exceed its peers. It continues to have a dominant market share, having really only one competitor, Visa and MasterCard being the only two in the space. It has an oligopoly when it comes to credit card processing. And one of the best parts I love about Visa, when you think about these downturns in the economy, like when Visa goes down hard right here during the recession and everything, well, guess what? When you own a credit card, you have a bank that is obligated to try to get those funds back from you. So if you have a Discover card, if you don't pay that back, Discover card has to write it off as a loss. But guess what? When you use your credit card, you don't pay the bill back, Visa already got paid because they don't want you to pay the debt back. They just want you to swipe the card because they get the exchange fee. That's how Visa makes money, as well as a lot of other ways. But Visa, high growth opportunity as we go more and more into cards and plastic rather than going into traditional cash transactions. But Visa, very good long-term bet right there. And then next up, we have the best financials company in the world, the best bank, the best adaptive, the most innovative. We're looking at Jpmorgan Chase. The $372 billion company has had a lot of upside recently in the last month or so. I was buying the stock like crazy in the 90s and the hundreds. I talked about it in some of my previous videos. Go ahead and check those out back in the past. But this company has had some upwards movement up from about $90+ a share all the way up to the 120s. And even at these prices, it's still a buy. It's not as a good evaluation as it once was, but even at 120, I'm buying this stock like crazy. Let me tell you, I think that once January 1st hits, and once they lift the dividend raise policy that the Fed has limited these guys to, I think that they're going to start raising these dividends in a massive way over the next decade. As long as we don't have some kind of recession that comes out of nowhere and this just ruins all the big banks, if basically we continue to recover the way that we're on track to right now, this company is going to raise its dividend at an incredible rate. That's just my opinion. But basically, when I look at it, if you're going to bet on a big bank, why not bet on the best in its industry? And speaking of the best in its industry, let's talk about the best healthcare company in the industry. Let's talk about the company that is so diversified, it's almost like buying a healthcare ETF. If you're going to own a healthcare stock, if you don't own Johnson & Johnson as a dividend investor, then you're not really a dividend investor. You're looking at a company that has 38 years 38 years worth of consecutive earnings growth and 58 years worth of consecutive dividend increases. What a track record this company has with over 25% of its revenue coming from products just made in the last decade. This company continues to innovate, continues to find ways to increase profits, increase revenues, and at a pretty compelling valuation right now. I think that you should be buying the stock steadily. And if it were to drop, if it were to go to the 140s, the 120s, or something like that, I'd be buying the stock like mad. It's at a pretty good price. I've been buying it a lot. Johnson & Johnson, they make everything from high dollar medical equipment all the way down to just basic Band-Aids and Listerine mouthwash. So this company set up very well for the long term. One of the best healthcare companies out there. And next up, we have one of my favorite consumer stocks. We have Pepsi. Now, while I do have my bias towards Mountain Dew and Doritos and all that stuff, this is a very good investment, okay? And by the way, I don't know why on M1 Finance, I mention this all the time. I don't know why it doesn't load up this little history right here. They have been paying dividends for the last 50, 60 years in a row, raising it every single year consecutively. But this company continues to find ways to grow revenues. I'll give you two examples. Just recently, they had a twist on their SodaStream brand. They added new little bubbly drops so that way they can increase sales with a new twist on their old product. They also just recently bought out, at the beginning of this year, Rockstar Energy. Energy drinks is a very high growing category in the beverage space, and Pepsi's now going to be able to take advantage of that and get a little piece of that market share. That's just two examples in the last year or so that Pepsi has found ways to increase revenues, increase profits, and that's why you should see a steady increase in share price over the long run as well as dividend increases. Basically, the way I look at it is that if you believe that people are always going to need something to eat, if you believe that people are always going to need something to drink, then Pepsi is always going to be there to feed them snacks and give them beverages to drink from, and they're going to make money from it. Next up, we have a company that has 60,000 products. You heard me right, 60,000. And 3M is a company that basically, as the United States grows, as the United States economy grows, 3M will grow alongside it. You're getting a hefty 3.5% dividend yield that has been growing every year for 60 years plus. And this company, while it has had a recent downturn in share price, they've been finding new ways to change their business model to become more profitable and focus on its more high-growing products than the old, boring ones. This company will get back to its $200, $300 a share range, and in the meantime, you can get a steady, safe-paying dividend yield that continues to grow every single year and is due for another dividend raise here in about another month or two. So stay tuned for that. I'm sure they'll probably be giving a decent raise here in the next month or so. But next up, we have Coca-Cola. I won't go too long into this one, but basically, if you believe the same thing with Pepsi, if you believe that people are always going to need something to drink, if humans are always going to need beverages, then what are the odds that Coca-Cola is around for the next 100 years? I think it's a pretty safe bet. I think it's a pretty safe bet that Coca-Cola will be around to the day that I die. If that's the case, they'll continue to pay out profits to shareholders. They'll continue to grow their company, and there's a reason why this is Warren Buffett's favorite investment, because it is an easy money stock. And next up, we have Caterpillar. This company has had so much better performance in the last 6 months than I thought it would. Look at that growth, okay? I was buying the stock like crazy in the 105, 110 range. And now we're talking about this company. It's almost in the 200s. That is nuts. That is bonkers. I was buying this company originally at a 4% dividend yield. Now it's almost less than 2%. It has grown so fast, so quick, and the main reason is the economy has bounced back much quicker than expected, as well as the potential for an infrastructure bill. So basically, Caterpillar has had steady income growth, and they are a lot more defensive for recessions than they used to be. It is pretty sensitive to the economy, but in booming economies, let me tell you, this company typically takes off. As you can see, let's just look at that from 2015, $65 a share, to 2018 to 170. You can see how this company grows in a massive way when the economy comes back strong, and that is what has taken place with this share price from about $105 a share back when I started buying it. Now it's at 175. So a big turn up there. Caterpillar, I'm still buying even at these levels. Now let's go ahead and go to the next company. The next company on the list is Procter Gamble. Arguably the most defensive company on this list. Basically, they make a bunch of things that you probably take for granted, like basic things like toilet paper and soaps and lotions and a lot of skincare products and shampoos and deodorants and stuff like that. Stuff that you scroll by in Walmart and Target that you don't even think about buying. You just purchase it no matter what your income is, no matter what your situation, because you find them to be consumer staples that you need to purchase every single week, every single month. So Procter & Gamble is very defensive in the fact that in most recessions, they usually don't go down nearly as far as the S&P 500 does, including here in 2020. But as well as that, they usually increase profits even in recessions because this company has such the type of products that usually get bought year-round, even in the worst of the economy. So Procter & Gamble, very good company to own till the day that you die because pretty much no matter what, people are always going to need shampoo and Q-tips and toilet paper and basic products like that. McDonald's, if you haven't seen The Founder yet on Netflix, you need to go check it out because it showed you how McDonald's is not a fast food company. McDonald's is a real estate company. And if you truly understand that, then you understand why McDonald's has had as much success as it has. Just in the last 5 years, $116 a share up to $211 where it's at today. And if you even look, even at the peak, it's actually doubled up in the last 5 years. With an incredible dividend growth from 89 cents up to $1.29 here in 2020, every single year this company continues to find ways to get a hold of new franchisees, build new restaurants, increase the amount of rent that it receives every month, and hey, also sell more cheeseburgers and fries somehow, even throughout the massive size of this company at $157 billion. But with the steady dividend raises and the decent dividend yield, the incredible share price growth, hey, you probably all know McDonald's and you know how it works. If you want to own a share of this company, I'm definitely a believer in it, and that's a reason why I make it 4% of my portfolio. Now, I won't go over this next one too long because it's very similar to that of Procter & Gamble. You're looking at the largest distributor and manufacturer of toilet paper and paper towels and a lot of basic paper products like that. Kimberly-Clark has had a very good price compared to what it's usually at. I've been buying the stock very heavily in the 130s in the last couple of weeks, and I think you should load up on it as well, having a 3+% dividend yield, which is pretty impressive considering we're in a market where the S&P 500 just gets a measly like 1.6, 1.7%. Yeah, 1.5%. I stand corrected. But looking at Procter Gamble and Kimberly-Clark, they're both very defensive and very good for a dividend investor. Home Depot is a company that has done much better throughout 2020 than I ever expected it to be. I expected this company to go down and stay down for at least the next 6 months, year, 2 years, because usually this company gets hit really hard in recessions. Well, guess what? Not in 2020. This company has not only stayed safe throughout this recession, but they have had the biggest boom in their business ever seen. They're doing record numbers in the pandemic. So the cool part about this company, usually it does pretty bad during economic recessions, but the fact that it's kept up even in a pandemic shows that it can bounce back, and it has a very dominant oligopoly between it and Lowe's. And basically, this store takes such a large amount of capital to get started and actually build out to a large scale that there's not a lot of opportunities for the competitors to really come into the space and really take over. It would be pretty hard. There's quite a bit of barriers to entry. But that said, this company has incredible margins on a lot of its household products. And basically, the way I look at it, Home Depot's been raising its dividends for decades. It's been around for a million bajillion years, and I don't think that's going to stop anytime soon. And that's why you can see why this company is over doubled up in just the last 5 years, and I anticipate to be there for the next double up as well. Next up on the list, we have Store Capital, the last real estate investment trust on the list. And basically, this company is focused on services, on the services sector, quite heavily compared to that of much of its peers. Now, this company did get hit really hard, and it just came back in a massive way. Go back and check out some of my earlier videos, because when this company was in the low 20s, I was buying it like crazy. I was recommending you guys buy Store Capital, buy Store Capital. And go ahead and look at it now. Now it's back in the 30s, and guess what? I think in 2021, 2022, I think it'll get back to the 40s. I absolutely see that. And even if I'm wrong, even if this company goes down and stays down, well, guess what? That's a great opportunity, because you're buying this company at about a 4.5% dividend yield. A great stock to own for yield there, and that is why I'm still buying it, even at those sky-high levels. And next up, we have the highest yielder in the portfolio. Now, basically, while I'm not super bullish on cigarettes and tobacco, they have a lot of different products between cigars, cigarettes, between Zen packages and pouches and other type of tobacco products. But basically, this company has hit very hard from its stake in Juul over the last couple of years, and I think in the long run they're going to be able to cover because they have an incredible track record. And the good news is that even if I'm wrong, I'm getting an 8+% dividend yield to bet on it. So even if I'm wrong, even if they cut that dividend, even if they go nowhere, I still got some let me rephrase that. I got some incredible cash flow in the meantime while I own it. This is probably the most risky stock in the entire portfolio, but it has some great yield and I'm willing to take the risk on it. We'll see what happens over the next year or two with that one. Next up, we have Lockheed Martin, the newest stock in the portfolio, okay? Lockheed Martin, you know how I talked earlier with Home Depot being a high barrier to entry business? Well, no other company in my portfolio has a higher barrier to entry business than Lockheed Martin. This company makes the bulk of all aircraft and other type of weaponry for the United States military. I forgot what it was. I believe they produced like 65% of all the aircraft contracts for the United States last year, something like that. If you see something for the military that blows up, that goes underwater, that flies through the sky, or other type of heavy-duty military equipment, Lockheed Martin probably produced it and sold it to them. They just continue to land hundreds of millions of dollars worth of contracts from the United States government, and their balance sheet and financials are so incredible that even if government spending were to go down, let's say 50%, they could still maintain their dividend, grow their business, and their new CEO, I think, is pretty capable of handling all economic recessions. And not to mention, speaking of economic recessions, this company is pretty defensive throughout any market. So I'm very confident holding Lockheed Martin. A very safe bet there with a steady growing dividend yield and a steady growing stock as well. Next up, we have NextEra Energy Partners. This is a renewables energy business. Now, when I look at these companies, I don't know a whole lot about the energy sector, and that's why I don't heavily invest into it. But if I'm going to invest in energy, I'm going to invest in renewable energy. One thing that's great about this company is that not only do you get a lot of yield for it, it also continues to raise its dividend every 90 days. And that's why this company has raised its dividend from 31 cents to the 40s to the 50s. And now it's raised up to the 60 cents a share. You can see just in the last 5 years, it's doubled up that dividend. And not to mention, if we look at the share price, 5 years ago this was a $23 stock. Today it's 63. It's almost 2.5 times in price in the last 5 years. It's going to new all-time highs. It's expected to grow about 20% in revenues next year, and I'm holding that one for the long term with NextEra Energy Partners. I think they're going to do just fine. Cisco is a company that's been raising its dividend for a long time, and they have a very dominant business in delivering food products to businesses, to restaurants, to cafeterias, to college campuses, to whatever needs food products available. Cisco is going to deliver it for you, and that's why this company, once again, if you notice the trend here, the companies tend to go gradually up over time. They continue to raise their dividends, and they have very safe, steady business models. This company continues to find ways to increase revenues, increase profits, and basically the way I look at it, people are always going to need food in restaurants. People are always going to need food in cafeteria. Well, guess who delivers all their food for them? It's probably Cisco. So Cisco is a good, safe company there, and they continue to find ways to increase revenues and profits. Honeywell is a company that's performed so much better this year than I thought it would. Look at that chart. I mean, geez, in like a month, it went from like $160 a share all the way up to the 200s. And just in the last 6 months or so, when I've been investing in it, I was buying this stock a lot in the 130s and even some in the 120s. Today, it's in 200s. So that's crazy growth there. And not only has it continued to go up in share price, but the dividend has went up over 50% in the last 5 years as well. Usually normal economic recessions, raising that dividend 10% plus every year. A very high growing dividend company. And one thing that's really interesting, go ahead and look at the quantum computing opportunity with Honeywell. I won't go into that. It'll take way too long to explain, but go ahead and do some research into that. And that's part of the potential for the huge upwards move in share price here. They're entering a high growth opportunity if they can pull it off. So go ahead and do some research into that. But Honeywell, a very good industrial company. That's a high growth opportunity. Next up, speaking of which, going hand in hand with high growth opportunities, the company that I'm currently up 128% on, Qualcomm, has had a uproar in share price. When I was buying this company, it was in the 60s. You heard me right. I started buying this stock in the 60s. You know what? Let's go ahead and check it out. I'm curious. What was my original purchase on Qualcomm? When I first bought Qualcomm, here's my first buy. Let's find there it is. When I first bought Qualcomm, it was $67 a share. $67 a share. Today, Qualcomm sits at $150. So $150 is a much higher stock price than when I was buying it 6-8 months ago. And this company's continued to raise its dividend. And basically the way I look at it now, well, I'm not too interested in buying shares at that sky-high valuation. It's already priced in a lot of the future growth. I'm still going to hold the shares for now. It's not at levels that is just absolutely insane. I'm still going to get my dividend payments because I have great yield on costs, and I'm sure they'll continue to raise that dividend in the next couple of years. But even if they don't, no matter what, this company's had a lot of growth. I think that there's a good shot that they get all the way up to 200. I don't know. I will be holding on to this company at these prices, but let's see if it goes up even further. So let's go up to the next company on the list. We're on the last few. The next one we have is Starbucks. Speaking of companies that have performed very well this year that I thought wouldn't do nearly as good, you're looking at a company that is now getting back to its all-time highs. It is now breaking $100 a share. And when I was buying this company, I was buying it at 2 and 3% dividend yields. Well, guess what? Now you can only buy it for a 1.69% dividend yield. This company has had massive growth, and basically one of the reasons why I love Starbucks is that white girls love coffee. No, I'm kidding. They do, but that's not the reason I own this company. The reason I own this company is that they have excellent management teams, great margins, incredible margins considering that they're only selling freaking coffee. I still can't wrap my head around that. But they're growing at a massive way. The corporation, not franchisees, the corporation owns over 90% of its stores outright, and they have other premium coffee brands coming out as well as expanding more into the merchandise business for their logo, for their brand. And I think that this company will definitely one day, out in the future, in the next decade, get to $200 a share, to $300 a share, and they'll have a growing dividend in the meantime. I think that this company, while it already has a dominant play in the coffee industry, I think that it'll just be the number one brand. If it's not already the number one brand out there, I know it's definitely close to it, and this company will continue to grow over the next decade. Next up, we have Verizon. The last two companies on the list. Verizon is my safe telecommunications play. This company has a slow dividend. It's a boring company. It really is. But one thing that's great about them, people always need cell phone. By the way, I don't know why that says 8% dividend yield. That's incorrect. M1 Finance is freaking out a little bit on me. But this company has an incredible 4+% dividend yield. And basically the way I look at it, this company continues to increase its cash flow every single year. And while that happens, they increase dividend payments, and you'll see a steady, slow uptrend in share price. Verizon is a boring company to own, but one that is very conservative and very defensive in most economic markets. And speaking of companies, the last but not least that we have that is very defensive in pretty much all markets, we have Waste Management. This company cleans up your nasty, gross trash. When you take your trash out to the bin and you throw it in that dumpster and you forget about it, guess who comes to clean up? Waste Management. Every time they come to pick it up, guess who gets paid? Waste Management. Waste Management is the company that cleans up your trash and makes money off of it. As the population grows and we get more nasty as a population, Waste Management is going to be there to clean up our mess and get paid while doing it. So Waste Management, a high growing dividend, a high growing company at that matter, and basically they continue to find ways to increase revenues. And as the company grows and the population grows right alongside with it, Waste Management will continue to see exceeding profitability. So that's my stock portfolio, the 25 companies that I currently own. I found a lot of success here in 2020. We're about to wrap it up. This is the last time we will be doing a review for my portfolio until the beginning of 2021. We will give my yearly numbers on that next video, as well as giving you the final updates to these 4 charts. So thank you guys for watching all the way to the end. I really appreciate it. Go ahead and subscribe to the channel and sign up with M1 Finance. Sign up for a mentoring call. Sign up for your auto savings account. Sign up for one of my credit cards, link down below. Whatever you want to do, it's all down below there in the description. But thank you guys so much, and I'll catch you guys next time.